Hello and welcome to this very special discussion where we are going to decode Budget 2017 and how it impacts your wallets and your investments. Joining me today are Nikhil Bhatia, partner at PwC, and certified financial planner Kartik Jhaveri. Thanks very much both of you for joining in today. Let's move to the real estate space because there's been a lot of changes and a lot of action there. So we've got 3-4 main points. Let's touch upon them one by one. First, Kartik, let's talk about the changes in the capital gains as far as the real estate space is concerned. The holding period for considering gains from immovable property has come down from 3 to 2 years. Can you take us through the implications of that?
So what happens now is that until now you had to wait for 3 years to sell a real estate, and now that's come down to 2 years.
Right.
But see, to my mind, I don't think this is a huge difference because ordinarily for most people when they buy real estate, people like to sort of have a portfolio of real estate over a period of time, you see. So whether it's a salaried person that we're talking about or we're talking about a individual person, a business owner, real estate or the investment of real estate has been such a great lure for centuries, and everybody wants to have a piece of land which is their own.
Right.
So once people buy real estate, they don't sell it so soon, and so ordinarily they are anyways holding for many years in the future. So to that extent, I don't think there's too much of a difference which has been made to their life. Of course, then if you're talking about people who bought real estate and who are in some sense giving money to developers and who are buying real estate from a very, very short-term perspective. So for them, it's a little bit of an advantage because then what happens is if somebody was going to hold between 2 years and 3 years, then that would have been short-term otherwise, and all the income, all the gain from there would have been added to their income, and on which they would be paying the marginal rate of tax, which could have been 30%, which is now not the case, and they will get a little discount on that. So that means after 2 years, if they sell, it becomes long term. But this is for a very small community of people, I would think, who are investors of real estate for a very short period.
Nikhil, I want you to take us through this part about the base period for indexation, which has been changed from 1st April 1981 to 1st April 2001. What really does that imply? How does that change things?
That actually is quite an interesting one and some probably long overdue because currently for long-term capital gains on assets held prior to 1981, you could you could step up your cost base equivalent to a market value as on 1st of April 81. And that's 25 years, 27 years from today. What they've done is that they've actually substituted the 81 to 2001.
Okay.
And therefore you will get a step up of your cost, which is long term, really old assets which you've been holding, to a cost basis equivalent to the market value as on the 1st of April 2001. So really the value which has probably, and some of these assets, particularly real estate, which would have gone substantially more, you would get a much higher step up of the cost base, and when you sell, your the capital gain that comes up for taxation is only the difference between your today's market value and the 1st of April 2001 value. So you get a fair amount of relief in terms of the
capital gains really goes down.
Yeah.
Okay.
So that's that's a relief for people who are really holding it for long term and then have made the gains.
Right. Kartik, there's also another loophole that's been plugged as far as the rental income is concerned that we were talking about earlier. Take us through that.
So this is a very interesting option. Now this was very, very widely used by a lot of people who are essentially what we call as the high net worth individuals, people who are high salary earners or high self-employed business earners. So what the provision was that if you actually borrowed money for buying a property, let's take a real example. Let's say you bought a very expensive 5 crore, 8 crore kind of a property and you took a loan for that. Say your loan was 4 crores, for example.
Right.
So even at 9%, 9 fours are 36 lakhs, approximately you would pay interest in the first year. Now, somebody who can afford a loan of 4 crores is obviously paying an EMI of 4 lakhs. And based on the income to installment ratio, that means his income is somewhere in the range of 7 to 8 lakh rupees a month, and which is a crore a year. That's sort of so we're talking of that section of that category of people. So what used to happen is that entire 36 lakhs or the amount which was paid towards the interest, you could actually knock it off from income from other heads, which is income from salary. So imagine you paid 36 lakhs as interest and you straight away saved a third of that, which is 12 lakhs in taxation. So that was a huge benefit which was available. So this is a part of the fine print. So now what's going to happen is this benefit has been now reduced to 2 lakhs, and this is just to sort of bring it in parity with somebody who was not using that property as a let out property. So what used to happen is on your self-occupied property, you have the limit of 2 lakh rupees as interest payment, which you get a deduction for. The same logic has been applied for all your secondary investments, which is your second property and your third property and your fourth property, which is nothing but your investment property or properties that you bought to either let out or just keep it for your own consumption. But for all those properties now, the interest cap that you will get as a deduction from your income is only now 2 lakhs. So earlier there was a huge amount of tax saving that used to happen, which is now not going to happen.
Be possible.
I have a different take on that. So it's actually going to, hamper or reduce your take on the housing, because to that extent the demand comes down. But if you were to apply the GST principle or the value added principle, every rupee of interest that you are paying, somebody else is paying tax on that.
Right.
Yes,
So I think in fairness, and I think in real time, because it's really the interest that you are paying against your income. And if you are earning income, if a businessman is allowed to claim deduction for every against income that he earns, why should not an investor in a property be able to claim that as a deduction? Because there's somebody else paying tax on it. So I think same way as, and to have taxed notional income on my self-occupied property by itself was a challenge, and globally a lot of countries actually give deduction for housing interest that you get. So it's again on the same principle, somebody else is paying tax on it anyway. So it's an incremental value added tax if you were to look at it that way. So to my mind, while it was a planning avenue, it was also a real expense that you are making in investment. And today I would be, if I was to go out for investing into another house, I would be disincentivized. So
that window is closed now.
Yeah, that window is closed. But
Correct.
Again, you're doing it for a planning purpose or whether you're doing it as a real investment, and that is one of the other investment cycles which is actually going into reverse. So you can look at it either
so
way.
it falls into the agenda of the government for incentivizing people who actually want to use end users of housing rather than people who are just buying it.
But it's again one of the things saying, why should government tell you what you should be doing? It's your money, you put it in. somebody else is paying interest tax on it anyway.
But then for people who actually want to buy houses for their use, the prices don't really come down.
No, but then what is happening, to my mind, and he can correct me, that if there are too many people buying this, then the rentals are coming down really well. So now today rental is becoming a lot more affordable. I mean, you're 3-4%. So people with high net worth are buying. So I would say let somebody else pay for the asset. I will just use.
You will enjoy it at 2-3%.
So it's economics will take care of it. I don't think government needs to intervene. But that's my view.
Right. Kartik, also you were mentioning that there's a TDS that will have to be paid if the rental income is above 50,000.
Yes, so that's another provision which has been added. So what is happening is, if you have taken a property on rent, and if you are paying a rent of more than 50,000 rupees a month, which is essentially 6 lakhs rupees a year, then you will have to deduct 5% as a TDS, which means, for example, if you're paying exactly say 6 lakh rupees to your licensor, the person whose property you're using, you will have to deduct 5% out of his earnings, which is on a 6 lakh, 5% works out to 30,000 rupees. So which means in the 12th month of your rental, you will pay him 30,000 rupees lesser. You will pay that on his behalf to the government.
Okay.
So this is just again to trap the whole situation where a lot of people would actually not pay this tax or would claim certain exemptions, or would not have taxable income and so on and so forth. So they come into the net one that they are earning all this money, and of course his limit is above 50,000 of rental properties per month. But it's an interesting provision, it's a good provision. And the good facility that you have is that you don't have to cut every month. You can just make a single lump sum payment at the end of the year, or one time in the year, in the financial year obviously. And depending on how many months will fall into your first financial year of the arrangement of your rental property. So you'll have to just think about that, and it's a single statement come challan, and it's easy. You don't have to apply for a 10. You don't have to do all that tedious compliance procedure. It's rather simple. You just have to cut away 5% and pay to the government.
Right.
And obviously give the challan to the to your landlord.
But procedurally, I think one more process. So against your point of saying, can we simplify for people? I think complying with TDS provisions and then managing defaults, because what is happening is on the implementation stage. If and when a TDS provision is not complied with, the enforcement against the deductor is huge. The penalties for non-compliance, the prosecution notices that keep on coming in, and you are actually acting as government's agent. You are actually doing a service, and rather than paying you 5% for that service, you are actually getting penalized. So I think that particular process for individuals can get quite tedious, and I think to the extent that now people are going cashless, every bank deposit is going to get tracked.
Yeah.
Hopefully this should go away finally and let the individuals who are receiving pay their self-assessment tax, because each of these process, while for government it's a good way of gathering and making sure things don't slip through the cracks. On the other end, when they are able to now track all the banking transactions, hopefully this should actually go away and it should be made less and less cumbersome for individuals to be doing this TDS, because in practice it's quite a complicated process.
Not only that, Avni, there's another very interesting thing which I want to mention to you viewers, just exactly what Nikhil said, that it's a cumbersome activity, it's an additional process, but the implication of not doing this process is also quite severe. So for example, I'll give you a relevant example. Recently we've started paying TDS on the properties that we are purchasing, right? So if you're a buyer of a property, you need to pay TDS on behalf of the seller, and if you don't do that, even if it's a, let's say, builder property where you're paying installments to the builder, if you don't deduct, electronically they are tracking your transaction, and for every day of delay you are being penalized. And you have to pay a very hefty fee if you actually have not complied with it. If you've been ignorant about it, one fine day there will be a big, huge, fat bill of penalties, and the penalties actually could be as large as your tax sometimes. And more.
Yeah.
So people need to be very, very cautious and careful about this provision. And if you have a property that you have taken on rent, it is your responsibility to deduct it, and you must do it. And you should not actually miss up on doing this thing.